Hello. This year, I thought that in addition to the investor letter that I write at the beginning of a financial year, maybe I'll make this video so that I try to cover the points that I'm writing in the letter. Uh, this was prompted to me by some of my very young audience, people who are just getting into the workforce, so late early 20s and mid 20s. They I got a lot of feedback saying that video is their preferred format, and they don't want to read uh, a few pages of written documents. And so I thought I'll make this video. I mean, I am more comfortable actually writing. So what I've sort of done is, I've written the letter, and I will try and talk through some of the more important points. But like I do whenever I'm speaking, I tend to speak impromptu. So I might add or subtract from some of the points that I've already made in the investor letter. So okay, so with that as a introduction, let me start. I think last year markets were extremely good. Markets, I think Nifty was up between 28.6% if I remember, and BSC 500 TRI index, which is index that we benchmark against. Uh, and the benchmarking is also a very interesting story. But I think we'll come to that. BSC 500 TRI was up roughly 40%. All the the funds that we manage through the PMS, the research services at IntelSense, we've all the strategies have done significantly better uh, than the benchmark. So I don't want to get into the numbers and all of that, because that you can always go back and check on the site. What is interesting? Okay, the point that I was mentioning about the benchmark index BSE 500 is NSE actually charges some amount of money when you use Nifty or any of the NSE major indices uh, as benchmark. BSE doesn't. So you will find that most PMSs, or especially ones which are not very big and who don't want to sort of spend a lot of money on things which don't really matter to the for wealth creation of the investors. They tend to go and benchmark against BSE indices. TRI, why TRI? Because TRI is a total return index. What that means is, when you look at, say, a Nifty or a Sensex, that is only the price movement that you see in the underlying stocks. When you have a dividend payout, it does not get captured in that index, right? So typically, if you have a TRI based index, total returns index, it also includes the dividends, and that is actually a much better representation of the overall returns, because at times in some stocks, dividend yield is a significant number, which can make a difference to the overall returns. Now let me talk about the main points, or how. So let me start by talking about what went wrong or what I missed last year. And this is an exercise that I do pretty much every end of every year, is just to sit back and think about the mistakes and how to get better, because I believe investing is like a skill and a craft, right? So every time, for example, if you're batting and you get out, you need to go back and address the underlying reason why you got out. If your footwork is somewhere off, or you're playing the ball wrong, if you're or you're it could be anything, right? So you need to go back and correct that. Similarly, as an investor, we need to look at our own mistakes, what we did right, wrong at reasonable periods of time, and usually 1 year is a good uh, time frame to just take a pause and reflect on what went right and wrong. So Let me start with what went wrong. I think in my past experience, what I've seen is mistakes of omission are far far more important than mistakes of commission. Now, what I mean by that is, I have been investing for a long time. I mean, practically, I was just thinking, I mean, 2 dozen years. I started in the year 2000, and 24 years have gone by just like that. Uh, and over these number of years, what I've learned is that the mistakes I tend to make is where I've studied a stock, I've studied a business, and then either I have not invested in it because of some reason, or I've invested with a very less allocation and have not scaled up, or I've invested and then got out very early. Right, so these are what I call in errors of omission, where you've missed out on buying or not really having bought the right quantity. Mistakes of commission is when you've bought at reasonable allocations, held on, and then not made money or lost money. And typically, the kind of framework that I have always, or at least the last 10 years I've used, is I tend to have time stops, I tend to have price stops in all forms of investing, short term, long term, which means that the worst that happens is I lose out on 25-30% uh, of price, and maybe uh, 2 quarters, 3 quarters of performance in terms of time. So to me, that is not catastrophic. The problem is more when I've studied a business and then not bought, or not bought in allocation, and missed out on stocks which have doubled, trebled, or even gone up 10x. And to me, that is a bigger regret, because we've done the work, but not didn't wasn't able to capitalize on it. Last year we had few examples. One, I think, the biggest example was railways. I did a webinar on railways there on YouTube. Pretty much, I think, before anyone in Indian market was talking about railways. We looked at railways, looked at the tailwinds, and it was very very obvious to me at that point in time that the railway, companies associated with railways are going to do really well. And yet, although I did have a couple of stocks in my various portfolios, I did not. I mean, truth be told, they've done extremely well, right? 4 or 5 times from the buying price probably. But I somewhere think could have done better. We could have had more allocation. We could have had one or two more stocks as a more comprehensive bet on the sector, because obviously there was huge amount of tailwind in it. Same thing played out in real estate. I've been speaking of real estate doing well, picking up on all my public appearances, in my writings, and yet my allocation to the sector was through ancillary that we're trying to play out. And although we've sort of rectified that over the last few months, but still that was a mistake that could have been that I mean that's something that can be improved upon significantly. The third sector, I think, which I missed out primarily because of my own behavioral bias, was the PSU stocks. I've always been a little bit wary of PSUs because I've always found, or not always, but I've predominantly found that PSUs tend to be, slightly not focused on growth, not focused on uh, delivering profitability, not very shareholder, friendly, because of the parentage, because of the overall, I think, mission in terms of doing social good, also as an additional, mission statement for these companies. But what I with that kind of mental bias, what happened was I completely missed out on the fact that uh, these companies were very cheap to begin with at the beginning of the cycle, and other than that, the revenues, the profitability was also beginning to improve a lot, and that's something that I sort of it sort of did not come into my radar because I was so negatively, sort of biased against these companies. So the lesson in this is, whenever you're looking at turnarounds, you should, leave your biases aside. And I mean, it's easier said than done, but that's something that you need to get better with. So that's pretty much, I think, what went wrong, what went right. Obviously, most things went right. The results tend to speak for itself. I think results have been really good, and the reason why I think a lot of what went right was because we were able to get into a lot of these, good performing sectors much earlier than the market. So, for example, we got into railways, we got into real estate, we uh, got into infra, we got into engineering, pharma, uh, much earlier than I think what the market was doing. So that is, pretty much what went right. If I look at how the world today is positioned, I think we need to understand that there is huge amount of volatility that is going on across the world. Russia-Ukraine war continues unabated. Uh, you see Israel, Gaza, Palestine situation that is continuing to flare up. The Red Sea, uh, attacks. If I remember correctly, I was reading somewhere there were like 60 cargo ships were attacked in the last 6 months by the Houthi rebels. All of this creates severe disruptions in supply chain because globally now business is more and more integrated. China, Taiwan continues to be a problem area for across the world because of the need for semiconductors. So that's something that we need to appreciate, is that we are today living in a world which is much more interconnected, and that makes it much more fragile. So I think markets are going to continue to be very volatile, especially this year when a large number of countries are getting into election mode. Or the ones which probably affect us Indian investors the most is the Indian elections uh, coming up in the middle of the year, US elections again in the middle of the year. So these will continue to remain at the center of news, uh, and you'll see pushes and pulls and news flow one way or the other, which will tend to drive markets uncertainty and volatility high. So expect a year of more than normal volatility. The second point that we are continuously sort of getting directly and indirectly is the China plus one strategy. Now, China plus one is actually playing out, and the point that I've always made earlier also is it's going to take a while. It's going to take 10 years or more for the China plus one to play out, because it took China more than 20 years to come to this stage of being this giant in manufacturing, and it is not going to reverse in 2 or 3 years. It's going to slowly and gradually, because think about it from a more practical standpoint. Now let's say you are a large US based company, and you are making you're making your stuff in China, and also you're selling that across the world. So for example, let's say you're an Apple, you're selling products within China, you're selling your product globally, manufactured in China. Now you cannot one fine morning get up and say that I will completely move away from China and stop making my stuff there. You will have to slowly build up capacity in other locations. You'll have to uh, also slowly start uh, creating capacity so that you can supply to China from abroad, or you only manufacture the products uh, in China for Chinese domestic consumption. So these are slow, long-term, strategic moves that is going to happen. It's going to take years and years, but the biggest beneficiary that we've seen till now, or rather the biggest beneficiary has been obviously the US, because of the AI revolution, robotics, all of this coming up. You need far less labor today uh, than 20 years back when all this manufacturing started moving offshore. So now manufacturing has also become a lot less labor intensive. So large part is moving back to US. Mexico, because of proximity to US, uh, has a very large opportunity. We are seeing growth in Vietnam, in South Korea, in Malaysia, Indonesia, India, South Africa. So all of these places, plus some smaller countries in Eastern Europe, these all of these places are going to benefit in this China plus one migration. Uh, but this is one theme that no matter what lip service people talk about, and again here it is not going to be a one-way street. It's not going to be that if everything is going to be against all news flow is going to be against China. Sometimes you will find the US president and the Chinese premier shaking hands, and a few days of bonhomie, and but it is more or less for certain that the Western world, led by US and China, take themselves as adversaries, and you would not want to be dependent on your adversary for stuff that you and your people are dependent on. I think again the Russia Ukraine conflict uh, actually displayed this, when we saw very large parts of, say, Germany or other countries being dependent on Russian oil and gas. So that's not something that the large number of Western countries in US and their allies are going to repeat, in my opinion. Uh, so this is going to be a persistent trend. India, I think we have a very great opportunity. My personal belief is that manufacturing is going to pick up a lot, and at least the present government is putting their weight behind manufacturing through PLI schemes. The state governments are trying to woo global businesses uh, in terms of setting up manufacturing sites in their states, uh, which ultimately is going to augur well for the country. We need a lot more manufacturing uh, because we have a very large pool of young people who need employment. We have a pretty large market to satisfy internally as well. So, all in all, if India can get its act together in terms of providing good infrastructure, a stable tax regime, I think India could really do well in manufacturing over the next decade. So that is one sort of mega theme that we need to be clearly focused on. The next thing that we have to look out for is the rise of artificial intelligence, AI, machine learning, whatnot. So AI has been around for a while. It's not that it's something which is just getting started. But what has changed with ChatGPT coming in has been the access to the common man. Like people like you and me suddenly get exposed to the magic and the wonder of AI. And then, like in any uh, uh, new technology, when it comes up, you start thinking of what great opportunities are there, what how well it can be used. And if you look at Then the typical curve that we see is, we see when a new technology comes up, and we've seen this before with the internet, with mobiles, in the last few years, or last say 2 decades. We've seen this play out, multiple times. We see a new technology coming up, huge amount of enthusiasm, huge expectations being built up on the disruptions that is going to happen. Then you get to a peak, and then there is this crash of, you know inflated, from inflated expectations to a point of disillusionment where you think that, nothing is going to happen with this technology. And then slowly and, surely, more and more use cases are built up, and more and more adoption takes place. If you go back and see, this is the same thing that played out with the internet, same thing played out with the mobile. And now again, the next recent phase is with AI. So what is happening now is, people are talking about, AGI within the next 2 years. AGI is, artificial general intelligence, which basically means that the machine is going to be as intelligent, or think like humans, which I don't know. I'm not an expert, but uh, I just keep reading about all the advancements in technology in this space, and the different schools of opinion. Some say it's not even remotely close. Some say we are the 2 3 years away. So again, this is an area where we need to keep a very close watch out on. And see, the interesting part here is how will it affect us as a society, as an individual, as businesses? How is it going to change the way we lead our lives? Because if you think about how every technology, new technology changes the way we live, and go back in history. I mean, say fire was a new technology at some time, iron was a new technology in some time. uh, Much later, or rather, more, say in the last 100 150 years, we've seen railroad, we've seen uh, airlines, we've seen television, radio, uh, mobile phones, internet. All of them have changed the way fundamentally people lead their lives. And again, I think that AI is going to fundamentally change the way we are going to learn, we are going to live, we are going to work. And how we adapt is going to differentiate, in us, from our competition, whether we are individuals, whether we are businesses. So we have to be very careful, and we have to evaluate, or continuously keep evaluating, how it is affecting the businesses we are invested in. Is it affecting it directly, indirectly? How, and in what manner, right? The next important factor, I think, again, which is playing out multi-decadal, I've spoken, written about it, many times before, is the transition economy. What we are seeing is, because of multiple factors like climate change, and unavailability, or constant geological concentration of fossil fuels, we are beginning to move away from fossil fuels to renewable energy. We are trying to move away from ICE engines to EVs or hybrids or those kinds of things. Uh, so this transition economy, what I call, is something which is going to be there for the next 20 30 years. Now, if you look at the numbers, that just to put out some numbers in terms of what India has done. uh, I think India has made three major commitments in terms of climate change. One is that emissions intensity to be brought down below 45% by uh, 2030. 50% of cumulative electric power installation is going to be non fossil fuel based, again by 2030, and India to become net zero by 2070. Now, What that means is today, the next 20-30 years, we are going to be on this journey of moving away from fossil fuels to other forms of energy. Uh, One of the biggest beneficiaries, in my opinion, is going to be nuclear power in all of this, because I think people are slowly coming to the realization that nuclear power is uh, one of the most efficient forms of generating limitless power with high degree of certainty. And obviously there are challenges, but so there are challenges with every form of renewable energy. And if you look at what again the government of India has planned, we are I think India is planning to add about 18 new nuclear power reactors by 2032, right? And we are planning to make around 1 lakh megawatt as installed capacity by 2047. So again, huge amount of plan that is there. And okay, so whenever there is a plan, I would also take it with some pinch of salt, because we have over the years across multiple areas not delivered to plans. But it's not that we have been very far away. In fact, in this particular climate change, or the commitments that India has made, India has actually been ahead of the curve, ahead of our plan. uh, Even if I sort of say that 20-30 years we may not be able to do it at this breakneck speed, but the general direction or the trend is very clear, that we are going to move away from fossil fuels led economy to renewables and nuclear based economies. And then obviously there are going to be repercussions of how these there are going to be geopolitical repercussions. There is going to be changes in the cost of power, which is going to again lead to a lot of other changes in the industry. So that's something to be again thought about. The next important point that I see happening around us is that globally we are going, the global economy is going through bad times. Now, if I look at US, difficult situation, I think uh, GDP growth uh, sort of around 3.5%. Similar inflation levels. China growth levels expected is about 1%. Eurozone one between 0 and 1. Japan practically zero. Germany, you know, expected to be in recession. India is one, bright spot in this entire, set of countries, which has some amount of a large economy. So my expectation is that over the next, say, 2-3 years, we are going to see a lot more of foreign investments, whether it is in equity, whether it is in debt, that is going to flow through into India. Interest rates globally, I think, are going to start to move downwards, especially in the larger economies. I think most of the peaking out has happened. It's either they stay here for some period of time, or they start inching downwards. Once that inching downward starts happening, we are going to get into another, equities is going to get one boost up further once more. Uh, but over, say, the next short term, long term, obviously India looks very, very good. And in the short term, I think India will have its share of ups and downs, lot of volatility. And the best way to look at how we are positioned in our strategies is, in our long term portfolios we look for good compounding businesses that are going to perform over the next business cycle. In our quant based or in our techno funda kind of strategies, we look for short cycles playing out and try to capture the alpha there. And I don't see too much changes in the strategies happening. uh, Overall, I think we need to look at periodic investment. So people who are doing SIPs, don't even think of stopping them. Just continue with your SIPs. I think that is a very good way of accumulating uh, your investments, and by staggering it over periods of time. Even people who do uh, staggered investment in individual stock portfolios, uh, even just try to space it out over a few months or few weeks, when instead of just buying it in one tranche. uh, that is what I would sort of leave you with. Thanks for listening to this. Thanks for watching me. Feel free to get back to me with your comments and uh, any suggestions that you have.